Welcome everybody. Sorry about the late post tonight. If you aren't early, you're late, they say. Doing good. How you doing? Welcome everybody. Yeah, man, the thing was a ripper. I can't lie, I foamed into that thing as well. Had to try it. Yeah. Me and Arcon does a lot of the class scheduling for us, and we just had a little confusion. I had told him I was going to do this one, and then I was supposed to remind him I was going to do this one, and then I forgot. So it's on both of us. But we're just going to cover these low IV ones tonight. And while this won't necessarily be a long-term investing lecture, you know, a lot of these low IV ones are some, good longer term holds. So it's kind of going to play both ways a little bit. So it'll work out just fine in the end. And maybe next time we'll do a full on, uh, long term lecture. What's up, Sonny? How we doing? Thanks for being here. Thank you, everybody, for being here. We're going to give it a few more minutes and see what happens. Oh yeah, low IV is substantially better for small ports, but then and we're going to touch on this, but we can kind of like chat, like I said, we're probably going to start around 5:10, 8:10, depending where you are. 10 after the hour tonight, just to give people a few more minutes to get here since I got that link posted a little late. But yeah, IV tickers are great for small ports. They're also great for big ports. It's not to be ignored. These low IV ones are not, you know, these aren't the trades that you are trying to enter to look for those big gains. If you're a big gain hunter, you want to be on those things, Nvidia, Tesla, the ones that can put in the big moves for you. These are those, much safer trades, minimal risk, pretty consistent, 10, 20, 30, 40 percenters that you can find them in the market most days. And so I love to trade them. I trade them all the time. As most of you guys know, I trade SPY and QQQ more than anything else, but I love trading the low IV ones, and we'll get into what some of my favorites are tonight, but there's tons of them. And so the lecture is going to be kind of, a little different. We're going to talk about the low IV tickers, no real charts involved or anything like that. But we're going to talk about them and then kind of explain, hopefully, if anybody has questions, of course, always welcome the questions. If anybody has any questions about them and why the things I'm saying, we'll get answered those. And then we'll just kind of check out a few charts on them and kind of discuss how to trade them. And if anybody else has some they want us to pull up, then we can make that happen as well. But while we wait another minute, how'd everybody do? Good day in the market. I know, let's be real here. One thing I've learned, most people in OOT hate a choppy day. And so I'm willing to bet SPY was not friendly to people on a day like today. Yeah, SPY fighting that 499, but we did, I was actually talking about this. I was actually just sending a message in a group chat about this. We had SPX hit that 5,000. We've had ES, break that 5,000, and we're holding it for now. And so really the last holdout for that big round number is SPY. So we want to see if they want to give it to us here sometime sooner than later. People always say they hate choppy markets, but that's just dumb. But ignoring that, what they don't realize, movement like happens in this square is what this provides explosive moves, whether up or down. You need consolidation for a big move to happen. And so, me, man, SPY 500, been saying it since 350. I'm hoping on that upside move. I don't necessarily think we're like blasting 500 or anything like that, but I want to see that 500 touch, get myself a victory lap. Top is in, man. You guys want, we've been pulling these up in the here we go. Top is in. Look at this one was even 1K. I wonder if 1K is in here. Yeah, we got you, bud. He's not tonight, but yeah, we got 1K. We had Zach saying we're about to crash back here. We had MMA saying he wanted to join the Bear Club dang near $16 ago. Good for him. Yep, this chart's a good one. One thing we know, bears always lose. But this one, shout out to Crash. This candle right here, he said a little invert hammer freestyle. And man, we never looked back. That's why that's the only level on the old funny chart that's gold, because that was just a sick call out from Crash. Okay, and with that, I think we are going to get rolling tonight. I got to be honest, I knew when I made that post in the live classes tab talking about this ain't NVIDIA, these aren't rippers. I knew we were going to have a nice lower attendance tonight. That's great. Hopefully it'll give everybody a lot of, chance to ask their questions if they have any questions, get a little bit more description on the types of things that I'm talking about. And so yeah, we know Lambos is always here. That's not even a question. Lambos goes to every lecture and he's the GOAT for it. We all know that. Okay, so with that, let's talk low IV tickers. As I said kind of before, some people joined. I think there's just a few of us in here. Man, my baby. What a low IV ticker is. What do we even mean by that when we say it? And so what it means in simplest terms is it's just a stock or an ETF or whatever it is that doesn't move crazy. Just to put it in simplest terms, like they're low IV. So what that means is low implied volatility. So we can assume just from hearing that the volatility on them is going to be lower, which means, you aren't, one I have pulled up right now that we're going to talk about is XLF. It's the financials ETF. You can see right here, took it 2 months to move $4, $6, whatever that is. It took it a long time to make these moves. These intraday moves are much smaller. And what we mean by that is just look at look at a big name, Tesla. Here's Tesla. Look at this thing is moving $10 in a day, So this is a high IV ticker. And so there's of course benefits to that. And like there's good reasons to trade them and all of those things. But these low IV ones provide really, really amazing things to trade, much lower risk. And because they're lower IV, we kind of talked about this a little bit at the beginning, for just a second, because they're lower IV, they cost less. So things like this can be much more appealing to either people with smaller ports or more conservative traders. You know, I get made fun of. I love it. You know, don't stop. I get made fun of all the time for selling early or whatever it is, you know, get a really good entry and then be out of it quickly. That's how I like to trade. I don't like to leave a lot of risk on my trades. So I just like to take the money when it's shown. And these low IV tickers, they pay you slower. They pay you safer. So for conservative traders that, you know, don't want to put on huge risk because, you know, something like Tesla, your stop needs to be wide. You know, you need that 20-30% stop loss on it, if not more, you know, because of the wicks that it forms and the volatility that it has. And so for somebody with a smaller port, or somebody that somebody that doesn't like having that huge risk and seeing those huge swings in their, like, you know, in their total port, then you trade these low IV ones and you take these gains when they're shown and you risk a lot less. You know, somebody with $1,000 port, they don't want to see a Tesla contract go down $60. They aren't trying to lose, you know, 6% of their port before it hits their stop loss. You know, you don't want to trade like that. And so on something like XLF, that's the first one we're going to talk about. You can see today it moved 25 cents. That doesn't sound like a lot. It looks big on the chart, you know, but I guess it did a little more than that, 35 cents if you somehow top ticked it, you know. But on something like this, you need to trade them a little bit different. And so what we're going to do now is kind of get into option contract selection, and how important it is on a ticker like this, something that is low IV. So, you know, as with all, you know, one of the difficult parts of these lectures is when we go back and we talk about trades maybe that we would have taken, trades that, you know, we did take, or ideas we had that worked and we didn't take, you know, those types of things. Well, when we're doing what I call hindsight trading, which, you know, it's, you know, I don't know if it's good or bad, you know, but when we get to go back and look, we get to pretend that we're very good traders. So on something like XLF, you know, we know that a big round number matters. So we can just kind of put a line on here. We know that 39 matters on XLF, you know, whatever, you know, like whatever that may be. You know, technically speaking, if we looked at the bigger time frame, maybe it's huge support or resistance, maybe it's not, but we know that a big round number is going to be important. So we come into the day watching something like XLF. Well, we want to be short on it below 39. We get a, you know, yeah, I am sharing my screen. I hope you can see it. Oh yeah, dude, Lambos, you're the goat, dude. That is true. We don't need the whole move. We just need part of it, you know, a few times. That's all we need. What's up, Joe? Happy to have you. Okay, so XLF, we're looking at it. We know we want to trade it. We know that we want to be short under 39. So as we start looking at this, we can know we want to be short under 39 just based on how it reacted yesterday, long above 39, you know. So we can come into the day and say we want to trade XLF. Well, now we need to pick our contract. And this is where I wanted to do a couple of these because we're going to pull up multiple contracts next to this XLF chart so that we can talk about them. So we come into here and we want to trade XLF. Well, we know that as smart traders, we want to have realistic profit targets. So, you know, like, we're going to go back to Tesla as an example. You know, I'll get these DMs. Tesla's trading at 190 and somebody's sending me pictures of 220 weeklies, wondering why they aren't making money. And I'm like, well, you're way too far out of the money for something like that. So on something like XLF, and any of the low IV tickers. We're going to talk about a few more after this, but we're just starting with XLF because it's one that I do frequently trade. And especially in a rate market, you know, financials are making a really good move for us. We want to trade a reasonable strike. So there's kind of two ways to go about trading these things. And when we're trading XLF, again, we zoom out and we look at the chart. You don't want to be in like 37 puts on XLF. They aren't going to do anything. You want to be in a much more reasonable strike. Because the IV is so low, contracts are very affordable. So when we come into this day, and we know we want to be short XLF, there is virtually zero reason to be in a weekly trade, a weekly contract. So we can trade next week's. And then this is going to be something that's really interesting because a bunch of people don't trade like this. But how I like to trade low IV tickers that move much slower is I want to be as close to the money as I can be. And if the price justifies it, I'll trade them in the money. And so that's what we're going to discuss here. So I'm going to pull up a couple of contracts. The first one, I got to link these real quick. Oh yeah, I'm still in those. So we're going to look at a couple of contracts and we're going to see the benefits of trading, in the money versus out of the money, some of the, the nuances of doing that. So what we're going to pull up first is we're going to pull up some 39 strike puts. And so that's what we have right here. This is Thursday. Let me get my indicators off of here because they make that chart hideous. So this is Thursday. You can see, as we talked, low IV typically goes hand in hand with low volume. So on these contracts today, there was only 900 of them traded, 7,000 open interest. And these are the next week. So 6 days to 6 trading days, more than that, 8 days total to expiration. But it gives us a lot of safety by not being in a weekly. So you can see on this option chart, hideous. We have one volume. You can see where people are getting in and out of these contracts. This is the type of thing that you will see on a low IV ticker. That's why I wanted to kind of start with XLF because it is low volume. So something you always need to consider when trading low volume is there will be spreads on the contract. So you will always want to limit order into something like this. But what we can see here is, we're going to pretend that we're taking this trade, in the money contract. So we know that, we have some safety because of that. We break down below 29. We look for this retest. So again, this is, again, hindsight trading. We got to pretend we're the best ever. So that's our entry. Our entry is this bounce back up. We've sold below it. At some point, bounce back up to 39, bounce back up to that 20 EMA. This is where we want to take our entry. Well, we come over here to the stock chart or to the option chart. We know that our entry is going to be somewhere around here. 29 or 30 bucks is what we're going to get filled at. Realistically, going to get filled at 30 bucks. So now we trade it like anything else. And you see this move down to lows looks like a pretty dramatic move. Well, when we start paying attention to this side over here, the low IV, slow mover really comes into account. This looks like a big old red candle. It is 5 cents, literally. It is a 5-penny candle, So you can hold these things. You can see that the volatility isn't super crazy on them. A SPY contract is moving dollars a second, so they're very volatile. Something like XLF, not volatile at all. Because of that, it becomes very easy to stay in the trade. This might scare you out, but your entry's 39. So you still you don't even hit break even on this bounce. So you keep writing these kinds of things down and you can see some people, we'll see about 10 people got out up here around $40, $42. That was where they wanted to exit. So we see this big move on the chart, looks pretty big on the chart. We're in them at 30, moves to 40. This is a 30% return. It never went red. We're in the money, so we have a mountain of safety with the trade, and we get a nice little 30% return. And then again, you can be trailing your stops down at 35, maybe get stopped out at 38. You're still doing 20 to 30% on a trade like this with a lot of safety, knowing that your close is a strong close over 30. But we've seen how these contracts move. So when we get a sell like this, it only adds a couple of dollars. So an advantage to a low IV ticker, the risk on them is minimal. You could have your stop 5-6 cents up here above you. If we're looking like we're going to push, you're going to lose maybe $1 or $2 a contract on that move because it's only a 5 or 6 cent move. So they add an immense amount of safety. However, you have to pick the right contract. So we're going to pull up another contract, and I guess we'll minimize this one so we can just see them better, and we'll just pull up the other contract. So nice 30% move on an in the money contract, plenty of safety, enough volume to get in and out of. Well, if we were being greedy and we hit this one, the 38.5, so we're not in the money, so we lose a lot of our safety. You can see there's a bit more volatility in price right here. The people at our entry that we would have taken, we would have got filled at 14 cents. 14, 15 cents, something like that is where we would have got in this trade. You can see we got a bounce, a $5 bounce, so they paid, well, 30% also. If you were able to sell the absolute top, realistically, you were down here, so you were closer to 20%, but you needed this big old move to only get a $3, $4 profit on your contract. If you're on Thinkorswim, you're making $2 or $3 a contract. That's just, the risk reward just isn't there on a trade like this. And sure, you can make the argument, well, I could buy 2 of them and I'd make almost the same amount of money, but you wouldn't, it would end up not working out for you because you're out of the money. And these contracts just don't have a lot of interest. There was only 400 of them traded today. So nobody really wanted to trade this contract because, and this is again, the next week, 38.5s. So you still have the safety of time, but nobody really wanted to trade it. And then the other side of it, XLF took a nice bounce into the end of the day. Well, say you didn't sell, you end up losing money and you stop out for an approximately $3 loss, which is a 20% loss. So if we go back to our 39s, if we rode these things all the way back to break even and we take our stop out, when it gets back to up here, you shouldn't, because it's not even above entry, you lose $1. That's it. You lose $1 on the contract. So no big deal, easy stop out, super, super safe trade. Is everybody getting that? You see why we pick those in the money contracts, especially with the price of them, with how easy they're easy to get in and out of, price of them for a week's time. It's a really safe trade. So does everybody kind of see why we pick the contracts that we pick? Hope so. Yes. Okay. Wait. Well, he spoke for everyone, so thank you. So next one we're going to talk about, low IV tickers. One of the advantages to them is that they are cheap. This next one that we're going to talk about it's a more expensive stock, and it's more expensive now, especially after yesterday. And so the next one that we're going to talk about, and it's something that, most people rarely trade, Disney. Obviously insane move off of earnings. They were expecting like a $5 move. The thing puts in a $12, $13 move by the end of it all. Really insane move on it. Right now, the IV, which we're talking low IV, the IV on Disney is obviously higher than normal because of the gigantic move that it made. We're even running into an issue with strike prices. They're going to be moving in larger increments, $5 increments, because nobody expected Disney to be back to 112. So nobody was selling, 106, 107, 108. They were selling 105s, 110s, things like that. However, Disney is here in the next couple days, we will start to see more strike prices sold on Disney. But if we can see this XLF move. It was small, it's safe. Maybe, your port is a little bit bigger. but you still want to trade these safer, slower moving stocks. But maybe you have a little bit more capital or whatever it is to trade with. So you want to, put on that little bit more risk for some of these trades. And so one of the trades that I was looking at this morning that I unfortunately ended up not taking, and it was due to the strike prices that were available. It ends up, it would have paid very well, but again, I didn't take the trade. So on Disney, again, low IV ticker. Ignoring today, if we zoom out and we look at Disney, this thing moved like a $2 day on Disney is big. Generally speaking, this thing's going to move $1, even we can see even back here, sometimes it's going to move 30 cents. That's all the move you're going to get out of Disney. Well, now that's a little more expensive. IV is still going to remain low. You're going to be talking 35% or less. That's about where I start to consider things low IV if you look at it. So on Disney today, one trade that I was looking at, and the thing that kept me out of it was the strike price. But I was looking at the next week 110 calls at open. So my issue with that was we were all the way down here. I wanted to close over this level for my entry. This is an old level from Disney. And so I wanted to close over this level. My issue with this was it's Disney. It typically doesn't put in huge moves. An $11 move, 11% move, that's not normal for Disney. So I wasn't necessarily expecting it to go $2 more. So I didn't feel comfortable getting into that trade. However, we're going to use this one as, we got to look back. We got to pretend we're good traders just to see the power of a lower IV stock that, like I said, they won't always put in a big, insane move like this. But we can still look for our entries where we want to enter them, breaking EMAs, breaking our level, breaking VWAP. Now we go into contract selection. We're limited by what we have. So we have a 210 strike on Disney. Now we get to trade it. And these ones are going to be higher volume than something like an XLF, or we're going to get into XLE next. That's kind of going to be a middle ground of these two. But something like Disney, we can look to buy these contracts, and again, they're, I don't want to say cheap because they are a little bit more expensive of a contract, but this is an 8 DTE next week, 6 trading days. Contract, so has safety due to the time, and we can start to manage our trades and understand our stops and understand our entries a lot more. So obviously we're taking these breakout candles here. We get to say, I am entering around this 130-ish area, because that's where our entry would be on this. Well, now we get to look at this and say, okay, my stop is below 107.79. That's what my entry is. Maybe you're going to use EMAs, anything like that. It's going to be a, 50-cent stop, something like that. So we can actually look at the option chart. We can look at these candles over here, and we know that when this stock was trading, down here below this level, these contracts were gone for somewhere between, $110 and $120. So we're going to, and we'll lower this even a little bit, we'll say we're going to be risking $18 on this trade because we know where our stop out is. And again, we're just, it's Disney. So we aren't looking for huge moves. So we can always say, hey, this contract's pretty cheap. It's got enough time. My first target is always going to be a previous high. You treat an IV stick or a low IV ticker just like you treat anything else. So on something like Disney, you have that safety of very minimal risk. You likely aren't going to get a gigantic death candle like you would see on Tesla or something like that. And this, it's a nice move. You're going to get a buck move up. And on a contract with something like Disney, if you do, and you can hold to these targets, if you do catch that nice move, you're going to be all the way up here at $180. And so you're up $50 a contract. Granted, this happened a little faster than it would normally happen on Disney. But if you're up $50 a contract, I'm going to do quick math in my head. I'm going to say that's like 40% on a $130 contract. You were risking a $15 downside move for a potential $50 upside move. So they're so much safer. And this goes back to what I was talking about with things like Tesla, things like Nvidia, where you really need to widen your stops. One of the big advantages to low IV tickers, they trade very, very technically. They reject where they should reject. They bounce where they should bounce. They respect EMAs. So you won't ever have those blowout candles on something like Disney, XLF, any of those. So Disney, definitely one of my go-to more expensive. And still obviously in the grand scheme of things, like we're getting a next Friday expiration at this point for $130. If you want to buy and that's as close to at the money as you can go. If you wanted to do something like that on any of the big names, Apple, Amazon, Tesla, you are going to be in it hundreds of dollars, and you are going to have much more risk on the table by doing it. Disney, a great middle ground, expensive enough that if you do have a bigger port, you can have those more, a more fulfilling return, something that is more worth your time and money. Or if you have a smaller port, you're still able to trade these contracts with a lot of safety and get a nicer move out of them. So I love Disney as that kind of, middle of the road expensiveness contract. Okay, so that's Disney. Next one we're going to talk is XLE. And I should have said this at the beginning. For anybody who doesn't know, there's the XL tickers. They are the different sectors of SPY. You can even see it up here, select sector spiders. That's what this is. It is that XLF is all of the financial stocks, which is a big chunk of the S&P, but it's just the financial stocks. XLE is the energy stocks. I see a good question. Always selling before close or multi-day trade? So it depends. That of course depends on two things more than anything else. First, was swinging part of your trade plan? Never swing a contract just because it's down bad. That's a terrible reason to swing a contract. So if swinging was a potential part of your trade plan, swing it for sure. You have a week's time. However, the other thing you need to consider is, are you happy with your profits? Because there's no reason to take the risk of swinging. Like that Disney trade was whatever, 30, 40%. Those XLF trades we talked, one was 20%, one was 30%. Do you want to risk giving that back? You do have the advantage of having a little bit of time. So theta is going to be reduced. And so you can, of course, swing. Another nice thing is going back to the XLF trade. And it's tricky. We'll go back to the XLF chart to talk about it. But we're going to pretend the bounce didn't happen. Well, if you're in here short and you've got a nice return on it, then you're in the money. So when you're in the money, theta is reduced to basically nothing. There is a little bit, but it's going to be like $1 or $2. So you have a little bit of additional safety if you want to swing an in the money contract. However, swinging should only be done if it was part of your trade plan. And if your gains are big, I think 9 times out of 10, swinging is a bad idea. And so, because you can get moves like this, you don't want it to go against you. So it's never a good idea to swing just because you're down bad. And it's never a good idea to swing just because you're up huge. It's one thing if you got a finance contract, you think it's got more, you can do those kinds of things. But swinging should always be in your trade plan before you make the decision to do that. Sick. J-Dub, thank you. I appreciate doing that. I was going to start listing them, but man, I tend to start getting them mixed up. And then if you do decide that you like trading these XL tickers, something you need to be cautious of is the liquidity of the contracts. XLF, good liquidity. XLE, good liquidity. XLK, which is the technology sectors, which is basically Apple, Amazon, Microsoft, the same thing SPY and QQQ hold, horrible liquidity. Borderline untradeable. The liquidity is so bad because if you want to trade tech, trade QQQ. So nobody trades XLK. However, XLE, really great one, plenty of liquidity, a bunch of people trade it. And the reason, one of the reasons that we're covering XLF and XLE today, beyond the fact that they're lower IV tickers, affordable contracts, can buy time, so you get safety. They're moving in the market right now. And have been. Obviously financial is a really big deal with any sort of banking stuff that's going on, any sort of rates, any of that. XLE, huge, because for the most part, it's oil companies. There are some companies in there that are pretty heavily involved with solar. So some of them have been getting beaten down with a lot of those solar names, but XLE moves really, really well. And so that's what we're going to talk on XLE again today. This is another trade that I wanted to take that I did not take because it never gave me the entry I wanted. So we are again just going to be doing a little bit of hindsight trading on it, trying to understand, the best ways to go about trading it. And so when we're looking at something like XLE, we want safety, and we again want to be close to the money because that gives us our additional safety, and then we know it's not going to move huge. This chart looks like it put in a pretty nice rip today, but when we really break it down, lowest low to highest high, it moved like $1.20. And so that's where, the main thing that we are doing by going in the money beyond buying some safety is we're increasing our delta. And for anybody that doesn't know, delta is delta is in all option contracts, and it tells us for every $1 the stock moves, how much money will my option contract gain in value. And so the deeper in the money you are, the higher the delta. And so when we know something makes a small move, we want to maximize that delta so that we can make a little bit more money by trading it. And so that's what we want to do on XLE. As I said, XLF slightly better liquidity than XLE. Disney better liquidity than both of them. But something like XLE is again, the contracts are going to have a pretty wide spread. So you need to be cautious of what you're purchasing. And so when we're looking at this XLE chart, and we'll see if anybody wants to chime in, what contract do we want to buy? Let's get some group talk here. If say we've seen XLE do this big pop and we're buying the pullback, what contract do you think we want to buy? See if anybody's going to answer. And if not, we'll just pull it up. So no answers. So obviously we have pulled back to 84. We're going to hit that 84. Because we know that we want that safety of being in the money. Yep, there we go. Everybody's getting it. Yeah, Arctic could exactly 83 calls if you're even feeling it. Unfortunately, the spread on them is going to clobber you normally. And so we're going to go 84s because this pullback puts us basically right in the money. So we'll pull up the 84. Again, low IV, so it's going to be kind of an ugly thing, but you can see plenty of people getting filled around here. So first pop up, we're buying this pullback. So we're going to get filled somewhere around here, $100, $110. We know at low of day, these contracts were $104. Our stop is going to be down here. So that low of day is our stop loss. So before we've even entered this trade, we're in the money. Of course, this will move us out of the money. We are going to be risking $7 on these contracts for our stop out. So, everybody knows who comes to my lectures, forget about profit targets. What you need to care about on any trade is entry and stop out. Because if you know your entry and you know your stop out price, then you know exactly how much risk you have on the table. This can also kind of help you position size, say you do have a bigger port and you're willing to risk, whatever it is, $50 on the trade, or we'll say $70 to make it easy. You're willing to risk $70 on the trade. Well, you can safely buy 10 contracts because you know your stop out is $7 below you. So that's your $70 risk. You can even, buy 9 instead and widen that stop just a little bit, still risking that $70. Well, again, we're hindsight trading right now, so we got to act like we're awesome. So we enter somewhere around here. We enter, somewhere around here, wherever it is. So we're in them. We'll say we're in them. $111. Stop out $7 below us. We're going to be trimming these recent highs, this one only going to give you a 10% gain on your very first trim, even a little bit more than that. That's great. 10% is great. Don't be greedy. 10% trades build ports very quickly, especially 10% trades that basically never go red. Those trades build ports very quickly. Well, we get a nice volatile bounce up. And we can just say that we are happy with our gains here. We took a $111 contract. We sold it at $137. So we're up just over 20%. That is a very, very great safe trade. You can see we start wicking down here because of some of these pullbacks happening. Well, we're still in the money. So the safety is there. A few people got filled low. 10 of them got filled, 11 of them got filled lower down here. But our stop is still not getting tagged. Then we can say to ourselves, if we didn't get this 20% sell, well, we get another 20% sell. Still never really gone red. I mean, maybe we were red, $4, something like that. Still, we get our second exit at our 20% fill here. Now we get another nice pop. And you can see on this chart, we entered at 84. This is a low IV ticker. So we move 60 cents and we make 20%. Well, we're getting deeper in the money here. Now we're $1 in the money. So our delta has increased dramatically at this point. So you can see we really get this pop up here. We aren't always perfect traders. We likely aren't going to be able to sell the top tick. But if we do, we can easily sell this 147, 148. And at that point, we're putting up a 30% trade that had very, very, very little risk involved. And so XLE, another great one. You can trade those in the monies. And then, I should have said, these are next week's. So that's why they hold up so well. Even on a pullback, they're still holding up well. And your break even is still very, very close to your break even price because you have that time, you've reduced your theta. I can look on this contract real quick for us. Your theta is $8, so it's not eating at you. I should just pull these up just to show you a weekly contract. The issue with weekly contracts and the weird expirations on the XLE ones is a lot of the time they're going to have a really hideous spread. So weekly contract going to be even cheaper. $50 you can get in one of these, and this is giving you a 50% return on that bounce. However, where that risk is your theta on this contract, and this is a contract that costs half as much as the other one. Your theta is 32, so you have a 3 times higher theta working against you by trading a weekly contract. And you can see at one point these things were down 10% from our entry. The other ones, the safe ones, you never saw red due to that, and these ones are still in the money, but so close to expiration, they will lose value much more quickly. So when we look at this one, nice pop. If you didn't sell 50%, you're psycho. But the drop down here made us almost 20% red. So there's really no reason, you can trade a weekly contract on a Monday, but as we, get to Wednesday, Thursday, Friday, buy those next week contracts. They're going to be much cheaper or not much cheaper. They're going to be much safer, and you aren't going to have that risk put on of a weekly contract and needing your move to happen fast. So that's something that you will always see. Uh, uh, the less time you have, if you're in a weekly contract, your percentage return will 100% of the time be higher. However, if you buy time, the percent return will be lower, but the dollar return per contract will be higher. So that's the balancing act of it. And so that's XLE. Again, one of my favorite things to trade. People see me talk about it in my tab all the time. Outside of tech, XLE and XLF typically have the largest effect on SPY during the day. So I watch XLE and XLF every single day. I take trades on them frequently. Even if we just pull out on it, this kind of goes back to, like, you can see how technically these trade. They bounce where they should bounce. They reject where they should reject. They're very, very safe, very, very technical things to trade. And so that's why, I love to trade these things due to the safety of them. So that's my spiel on the low IV tickers. And now we got 13 minutes left. I'm hoping you guys have questions, whether you want to talk about, just some things I talked about, talk about some charts, whatever it is. I see we already got a few questions in here. Let's talk, let's talk low IV, let's talk high IV. We can talk about anything now. So feel free to send those questions. See, we got Joe. Yeah, and so Joe, that's it. You're getting clobbered by theta. And then, so I love Greeks on option contracts, but a lot of people don't. And something that a lot of people don't consider, everybody talks about delta, everybody talks about theta, because delta is how much you're making or losing, and theta is that tax of the market just for owning the thing. So they're always, they aren't always, but they're working against you. The one that nobody talks about, but that they should, is gamma. And so what gamma tells you is how much your delta is going to increase or decrease. So that is a leading role in, you buy SPY calls at 498 and then it drops to 497 and comes back to 498. Well, you've lost value due to, and you aren't break even. You've lost value due to theta. You're out of the money too. So you're losing value due to that. Then when gamma drops your delta, there's another Greek nobody talks about, but it's the one that controls gamma. Your gamma will also drop. So maybe your delta when you bought the contract was 45. Well, then it drops down and your delta drops to, say, 35. Well, the gamma is not going to do an even increase. So when you go back up, your delta might only make it to $40. And so because of that, the delta won't cover the value and you won't be break even at your entry. And so that's why those things get beat up. And then if you're buying them late in the day, they go to zero at the end of the day. So theta's effect dramatically increases the closer you get to expiration. So that's why it's so, if you have a contract that goes, a bit against you and it's the same day, it can be very, very difficult to get it back to break even. And then something that a lot of people don't talk about, if you buy a contract at $40 and it drops to $20, you're down 50% on the contract. However, the increase from $20 to $40, you now need that contract to move 100%. And so that's why it's so dangerous to trade those same day contracts and hold them for too long, because people don't ever take into account, like, okay, my contract's down 50%, but like, if people are buying it right now, they need it to double just to get back to where I am. And nobody likes to, deal with that. Do I go next week on the high IV stocks? No, it depends what it is, how I'm trading it. Is it a scalp? Is it more of a day trade? But no, because the cost is too high. So, we can, again, we'll just, go back to Tesla because everybody loves it, even though it's dumb, And so at the money Tesla 190 weekly, $150. And you get 46 delta. If you buy next week 190s, they're 465 delta or dollars, and you only get 50 delta. So you pay 300 and some odd dollars more for 4 more delta. So you buy that $450 contract, and if you get a $1 bounce out of Tesla, you only make and that's relative, $50 is a lot of money, but you only make $50. Well, the risk reward is on that closer one. You can buy a $150 contract for $40 and you make 30% on the trade. The other one you make under 10%. So if I'm trading a higher IV thing, then I am trading then I'm going to be trading those weeklies, and there's of course risk involved with that, and I don't recommend it for everybody, but it is something that I like to have. I like that little bit of risk of those weeklies just because the reward can be so much better, but the risk is also higher, so you can lose more. Out of context, what am I seeing on NIO? Good one to ask about. Lowish IV. This is a setup I love. So we have very strong downtrend. No questions asked. Stock's down ballpark 50%, in the matter of a month. Breaking trend. So we broke trend. We tried to break it, retested it, took a gap up. Now I see this. And so this is something I like. You'll hear me talk about them all the time. Flips talk about them. I'm going to get rid of this one. Flips talk about them all the time. Inside candles. So we have big breakout candle. Now we have a candle completely inside of this one. This candle completely inside of this one. So this is offering us a very nice trade. I mentioned NIO on Trade Floor. I'm wondering if you saw that. I asked Shark's opinion on it because this is a classic Shark setup. Shark loves breakouts and then getting super tight. So this is a setup that I like as a long trade. If we can pull back anywhere to this 573, these contracts are, these things are dirt cheap. This is a $5 stock. You need to trade it. IV is, funny enough, higher on this thing. And so because of that, the contracts are actually going to be, they aren't going to be like stupidly dirt cheap, but they're going to be, they're still going to be pretty cheap, and so on something like NIO, we're going to treat it the exact same way. We look at NIO. This is a great big candle. Don't get me wrong. It's 30 cents. So you don't want to be trading those wildly out of the money contracts on something like this. So I'm looking at a NIO trade off of about this 575 area. And I'll likely buy 3 weeks a time. I'd be looking for a $40 contract, $50 contract, something like that. And so let's just pull one up. I just clicked a random date, February 23rd's 550 calls. So we're already in the money. We have a ton of delta, 68 delta. So if we can get the pullback to here, buy these things at like $50, well, we know we have 60 delta. So if we can get, this is basically a 30-cent bounce. If we can come back to here, our contracts cost us $50. We have 60 delta. We actually have 70 delta. My bad. It's 69. So we have 70 delta. So if we can get a 30-cent move up, then we know we will get approximately 33% of one delta. And a delta is $70. So we'll get $23, $22, whatever it is. Well, our contracts cost us $50. If we can make $20 on them, we're doing 50%. If we $20 to $25, we're doing 40 to 50% return on a 30% move up. Stop obviously can be down here below, below this level, even all the way somewhere down around these lows. We're risking 10 cents or 10 cents on the stock. And so we know that that is only 10% of the delta. So we're going to be risking about $7 to make about $20 in an ideal world. So NIO's one that I'm just watching, getting tight, has broken out. I think that, some of these, lower quality EVs might want to be getting to run in. And so I kind of got my eyes on NIO. There you go, Shanks. Very, very good point. I'm super happy you brought that up, especially because we're in the thick of it. Earnings. Everybody wants to trade earnings. That's dumb. You're dumb for trading earnings. I'll come right out and say it, it's dumb. You don't want to trade, like, you don't want to trade earnings. You will likely lose money. Everybody loses money. Very few people make money trading earnings. However, say we're going into earnings season and we got Chevron, Exxon, and Shell reporting, and we're bullish on oil. XLE where you want to be, because IVs, it's going to increase a little bit due to earnings, but it's not going to be high. Your contracts are going to be cheap, and any move you get, you're actually going to make the money on, unlike most other earnings. So I love to trade these things for earnings trades. Oil companies reporting, trade XLE. You got Bank of America, JP Morgan, all of those things reporting, trade XLF. I do it all the time. Even when I do want to trade a big tech earnings, I trade it by the way of QQQ. I don't want to be the person that's in, some $600 contract. We get a big move out of it, and my contract still goes worthless because the IV kills me. QQQ, you make that money. Whatever move you get, you make that money. And so I love to trade the X indicators, whatever they are, or XL tickers, whatever they may be, for those earnings trades. So I use them like that all the time. Thanks for bringing that up, Shanks. I love to see it. And I know you were asking about, can you see a larger move? Absolutely. That's on the back of earnings. You will see those larger moves. But it's just a great, safer, lower risk way to trade it. Oh, are you telling me Neo's already ripping without me? Yeah, I wanted to hit that thing today. Oh yeah, oh no, it's dropping without me. Yeah, let's get it down to here. See, because I saw this one's on a rip. Everybody knows I hate this stock, but Rivian going insane. I'll ignore my toasty level, but an absolute ripper on Rivian today. I mean, it was up 6% at close, and it's doing another 6% after close. Yeah, check Baba. Man, I hate to check Baba. It's impossible to trade. Thing never works for me. I mean, let's be real here. There's only one trade on Baba right now that should be attempted to be caught. But you want this gap fill. You want to be short on Baba down to the bottom of this gap fill. However, Baba puts up, great earnings, blows out earnings, and is down over 10% off the back of it, So it is a risky trade. China trades very, very rarely do what you expect them to do. However, the obvious trade right now is short to try to fill the rest of this gap, or wait for us to get back above these gap levels and look to get long and reclaim some of that earnings drop is where I would be. But man, the China names are just too hard for me to trade. They're too heavily influenced by news and opinions and all of this bad stuff that they are really, really difficult to get them right. But the nice trade is, I mean, honestly, entering short somewhere around this 71 with a stop above it if we look like we're going to push back up, and then try to ride that thing all the way down here below 69, or at least 269, something like that. Or again, get long up here. I mean, honestly, not even above the gap fill. I'd wait for this 73.20 area to crack. But again, I'm not going to lie to you. I'm terrible at trading China names. So I don't. Check X. We can. So X is super tricky right now. I haven't been following the news again. Obviously, took that little, bit of a sell here. Weird to see it being bought up before the dividend date. X is getting bought out. The buyout price is around 50. You can risk along here, but you need your strike below 50. You might notice when you look at the strike prices on X right now, very few people are trading it because they're waiting on news. They're waiting on buyout news. So the contracts will have a disgustingly large spread. They'll have basically no volume. And there will be basically zero volume unless any volume you see above 50, or open interest rather, that you see above 50 is somebody that was in that trade before the buyout deal came. Because the bid will be 0, 50 and above, because the price will not go above 50, because that is the current buyout price. So you can risk the potential arbitrage trade up to 50. However, there's a second side of this. And, for anybody that doesn't know, X is US Steel, United States Steel. Well, the company that's trying to buy US Steel is a Chinese company, and the market doesn't like that. In any other situation, that if it wasn't like that, X would be untradeable and it would be stuck at this 50 level. However, the market still doesn't really want it to be bought out by a Chinese company. So you can risk playing some of these bounces. In fact, I did trade this one back here. The contracts don't move friendly. They're hard to get in and out of. So X is sort of a riskier trade, in my opinion. Maybe you can get that bounce. Maybe you can even trade it by the way of shares and try to get that $2 or $3 bounce up. But those contracts are difficult to trade. I mean, I'm even right now, I'm looking at the month out March contracts. I guess I should go March 15th for the OPEX date. Give me a second. There was 2 volume on them today on the at the money contracts. So it's hard. It's really hard to trade. Shanks. So that's my response to X. But again, don't go above 50 in any strikes. Likely go at the money and try to catch any arbitrage move back up to there. But again, deal falls through, thing plummets and you're losing money. Deal gets more confirmation, it's going to go to 50 and not move past there. So you need strikes below 50. Another issue, when the buyout comes through, the market will reprice the options. So you need to be conscious of what you buy, because, a 48 call on X, if the buyout goes through at 50, will be worth $200. That's it. Like, it will be worth $200. It will only be worth the intrinsic value of it. So, make sure you're buying at a good price and planning ahead is all. Would I consider TLO IV? Absolutely. It's, everybody knows it's my favorite. I was trying to not talk about it today. Classic my form, got long back here, had a few people ask about it. Thankfully, I trimmed a couple of the contracts, got some bad news, clobbered it. I'm just avoiding talking about T. It is just terribly bad luck every single time I do. So I'm being cautious on it. But if you are looking to trade T, main thing that I'm watching right now is this zone, where previous consolidation zone, where it's bouncing. So if you were looking to take a stab, which I may or may not have, this is the place to take a stab with the stop below it. Can we look at Meta? I mean, sure. I don't know what you want to say. I mean, it's on the rip of a lifetime. Took a huge run on the back of those dividends. We'll see how much the market loves it. But for now, don't be long Meta up here and don't be short Meta down here. 470, likely a really good place to try to be short. Tight stops above it. Down here, 455, 452, whatever, big range. 452, obvious place to get long with stops below it. And then potentially, this gap is, I doubt this gap fills anytime soon. And when it does, it's not just going to be an overnight $50, $60 drop on Meta. It's not going to be a super easy gap to trade because it is so big. So, you don't want to get super greedy on it. But for now, you just look at this thing on the 4-hour. It's in a range, very tradable range. But I treat all ranges the same. I'm long at the bottom, I'm short at the top with stops around it. And then again, if we break out, look for that pushback to these all-time highs, these highs over here. But for now, I'm not entering Meta long up here. Intraday scalps, whatever, obviously, like, you can, like, plenty of money to be made trading at this top of the range. But I'm still not, getting deep long or anything like that. That's for sure. But that's just me. I'm too conservative of a trader to try to, like, I don't buy breakouts before breakouts happen. I don't buy breakouts before, or breakdowns before they happen. And I don't trade in the middle of the range. So if this thing's anywhere around basically like 462, no trade. Like, it's just not for me, Oh man, yeah, that one's on a ripper. That one I'm sad. This one I wanted to hammer yesterday, but he mentioned it to me and I did not hammer it. Big sell on it. I missed the end of the day. I heard I should look before I say anything else. Yeah, I heard there was some selling going on chips. My stance on chips does not change right now. If you're shorting it, you're a degen, you're gambling. If you're shorting Nvidia, if you're shorting AMD, don't get me wrong, just like great short right here. Fine. AMD the other day, my buddy even asked me, I feel bad, don't get me wrong. He asked me, hey, I want to get short AMD here. And I was like, not for me. I'm not going to short chips. I'm not going to jump in front of that train. Contracts paid huge the next day, the ones I told him to not trade. I think all chips, all chip producers, those companies that are like SHMW, I think that's what it is, that are providing the things those companies need to make chips, every dip should be looked at as a buy. And that was something my buddy and I were talking, he missed this short, he hammered the long, and he ran these contracts $8 in the money and absolutely printed on them. So I won't be shorting these things. I think that Marvel's got some, or however you say it, has got some juice left in it. I would really like to see it tag these highs. I didn't get in today, even on the pullback, because I was worried it might not hold its gains. We ended up with many more sellers than buyers today, it looks like, but I'm still overall pretty dang bullish on this thing. Yeah, I mean, and that was a sick trade. But like I said, just for me, like, I'm sorry, like, and we can go, let's see if I got like a blank one somewhere, maybe, or at least like less lines. If you look at this chart, you should not be proud of making money on puts. Like, you should be disappointed in yourselves. And don't get me wrong, here was a great chart, for that September, October, whatever it was. But you should not be proud of shorting this. Nvidia. Like, if you are, and I'm just clicking on a random one, if you are short on this, like, what are you doing? Like, why you, like, the amount of risk and the amount of stress in shorting something like this is just beyond me. Does it offer some great shorts? Yeah, but I'm going to ignore that, and I'm going to buy the dip, and I'm going to make substantially more money buying the dip. Don't get me wrong, if you're trading some intraday scalps short on it or whatever, fine, but I still view every single chip as a dip buy. If you have a company that is making chips, help making chips, anything like that, and they are involved in AI, you look for dips to buy. Sure, there's scalpable opportunities intraday, I get that. But for me, I'm just not going to do it because it's so counterintuitive to safe trading. I want to take trades that I have a high confidence in. And one thing we know about NVIDIA is, like, sure, you can short it, and there is a very, very good chance that thing is going to be up by $40 or $50 in the next couple of days. It has happened. I mean, look at like, sure, there's short opportunity, but buy the dip. Within a day, you were up $40. Buy the dip, and you run it from 663 up to 708. Buy these dips. Look for these dips to buy, and you make money. Don't get me wrong. Look, here's one. You probably made money. I mean, it bounced like $5, $6, but maybe you got stopped out of that one. But buy dips. Buy anytime these things pull back, anytime a chip double bottoms, hammer that thing. Like, buy these dips. Just keep, and I'm not saying like buy every dip, obviously, but like, buy the dips on chips. Quit trying to be the hero that, shorts Nvidia and makes money. Like, nobody's impressed by that. Like, nobody thinks that it's cool that you made money shorting the strongest thing in the market, and so buy those dips and trade those dips, and like, that to me is how you should be trading all chips. Don't get me wrong, great shorts available. I'm not going to deny that, but 9 times out of 10, you are better off letting that dip happen, maybe scalping it a little bit and buying that dip. The dip buy on chips is a hard to lose on game right now. So that's my stance on all of them. I don't care the chip. I don't care the chip producer or the, product provider. Buy those dips on them. It just keeps working over and over and over again. And you don't have to like stare down big old losses on your shorts. So you just buy the dip. Yeah, Lambas, exactly. Buy all dips. We call the dip, buy it, Chips are dipping, dude. I love chips and dips. So let me hammer it. What expiration do you go on chips? It's hard, so AMD, basically if I'm trading chips, and I trade them rarely, I trade SPY and QQQ. I like to trade them. Treat it by port size. You got a small port, don't trade Nvidia. That's simple, but you want to trade AMD. That's fine. If it's Monday, Tuesday, trade those weekly contracts. They're cheap enough, they pay great. If you have a slightly bigger port and you want more safety, trade the next weeks. On something like Nvidia, that gets to be like, Fridays are fun on them because the contracts get a little bit cheaper. But like, I'm sorry, I just pulled up the Nvidia contracts. If I want to trade an at the money Nvidia contract, you're telling me I have to pay you $530 on a Thursday? That's a hard pass for me. The risk reward isn't there. Don't get me wrong, you can go a little out of the money because of the moves that it makes, but still, you buy a $10 out of the money contract and it costs you $400. I'm good on that. So I don't trade Nvidia unless it's like Friday, but AMD, MRVL, some of those cheaper ones, you can trade those weeklies early in the week. And then if you're port, and you want a little bit of safety, trade the next weeks, and so that's, those are some, everybody wants to trade chips and nobody should be trading chips unless you have a port that can support it. They're so volatile that most folks can't really handle it. But if you can handle the risk, go weeklies. If you want a little more safety, go next week's. A couple more low IV stocks to watch. Great question. And I see it's 6 o'clock. We got a few people disappearing. So thank you so much for being here. If you got to go, I appreciate it. Thanks for being here. Some other low IV stocks I love to trade. Coca-Cola. Always a really, really great one. Very, very low IV, trades very well, does the same thing. You still want to be trading those, like, if we're at 59.80, 59.90, you can trade those 60 calls. Or if you're trying to short it and we're 60.20, you're fine shorting the 60s. It does move a little bit. Nah, man, isn't KO earnings tomorrow morning? I think. I could be wrong. Let me look real quick. Oh no, where did it say it? Oh yeah, okay, cool. It must be next week. Yeah, that's one that I want to trade. I love trading that earnings, nice and cheap. But Coca-Cola, another really good one. All about trading Coca-Cola. Another one that a lot of people don't think about, Walmart. This one kind of goes into, more expensive than Disney. So contracts are going to be a little bit more expensive, but Walmart is a very, it's put in a nice run, but a buck 50 day on Walmart is a good day on Walmart. It doesn't move super fast. You can see just grinds, like took it 2 months to bounce $19. So Walmart, another really, really great one to trade. I love to, love to trade it all the time. Yeah, nice gap fill on it. I know this was actually a real good trade. A buddy of mine trades this all the time and he does really well trading Walmart. Another definitely really, really great lower IV stock to trade. Let me think of some other one. Something, there's some riskier, as it's hard to, think of some more low IV stocks because, we do have volatility with like earnings week going on right now. A couple others that I like, but they've just had some volatility behind them lately. CCL, it's Carnival Cruise. It's another one. Slow mover. Dollar move on Carnival is huge, so this can be very, very great one to trade. It's much lower IV, trades very, very slowly typically. So that's another one that definitely like to trade it a lot. When I see a nice trade on it, it's something that I do try to hit. I miss a lot of trades on it because I don't focus on it very much, but it's another really good one. And then this is kind of a unique one. Liquidity kind of sucks. But it's the Jets ETF. And so this is basically a travel ETF. It holds a lot of the big airlines. And you can see again, slow mover, safe mover, a dollar move on it is giant. So this can be a really great one, and God, we're actually getting a pretty good breakout right here. Jets, you can look to be long above this 1950. Any pullbacks to that, buy it with a stop below it. So Jet's another really, really good one. Lower IV liquidity can suck on the contract sometimes, but can be a really, really good one. Okay, well, if that is gonna do it. Oh yeah, we ran a little late today, already later. Uh thanks for being here. I appreciate all of you. Yeah, I know Walmart split soon. I'm kind of hoping we get a run on Walmart due to that. Yeah, thank you, Sunny. Thank you, everybody. Arctic, thank you for being here. J Dub, thanks. Yep. Thank you, everybody. And we will catch you tomorrow. Uh Friday, you know. So trade safe, have fun. Thank you, everybody. Talking low IV tickers. Man, we even had like almost 50 of us in here. That was good. I was shocked. Yep. Friday. Yep, there you go, Lambos. Don't get demolished. It's Friday. So let's see what happens. Let's see what happens. Okay. Thank you, everybody. Have a really awesome night, and we will catch you all tomorrow. Have a good one.